In this video, we're going to talk about the poor man's covered call option expiration. What happens when you write that covered call and they take your shares? That's what we're going to talk about, and I know you're going to like it.
Let me show you my eyes.
Hey, welcome back, everyone. It is time for another red-hot covered call video. Hey, look, today we're talking the poor man's covered call. We're talking about early exercise of your option. There's been some videos out there on YouTube talking about early exercise of your covered call option, and I'm getting emailed about it. So I want to talk about it today, and I'm going to encourage you, if you're interested in the poor man's covered call, I have a video that is the most comprehensive video. It's the easiest video to understand on YouTube. In my opinion, I did it. Go to my channel, click videos, and you'll see it right there. Now, if it's not there, in the search window, type poor man's covered call. Now, hey, look, while you're there, if you like what you're hearing today and you want to be a part of it, subscribe to the channel. It's right there and it's free. And hey, look, if you like this video today, bang that like button. It lets me know you like what I'm doing. Now, what we're doing is this. We are talking about early exercise of your covered call option when you're using the poor man's covered call strategy. Now, the poor man's covered call strategy means what? You don't own the shares. So what happens if somebody exercises early on your covered call option? I know, you go, yikes! I know, I've been there, done that. So what I want you to do is this. I want you to go to ctpdashboard.com, click free spreadsheets, and if you scroll down, you're going to see my free poor man's covered call tracker spreadsheet. That's where we're working from today. I'm going to show you how it works, and I'm going to show you how we're going to deal with an early expiration of a covered call. Now, before we get going, I want to remind everybody, head over to the upgraded CTP Dashboard and check it out. Look, it's time to up your game. If you're not a part of what we're doing at the upgraded CTP Dashboard, I want you to think about it. Look at everything you get, man. I know you're putting real skin in the game. And if you go there right now and you click that down arrow, your special offer's right there. And if you're still wondering what we're doing at the upgraded CTP Dashboard, just check it out. You get 4 screener dashboards for ETFs, dividends, closed-end funds, and of course that list of the 100 best stocks trading now. And hey, look, because you're putting real skin in the game, I try to up your game with all my real-time trades, my chart of the week, and I love doing my chart breakdown video. I'll tell you, so many things coming to the upgraded CTP Dashboard to up your game. Check it out after this video and see the free offer that's waiting for you. Now, hey, look, I want to say thank you for spending the time with him talking about the upgraded CTP Dashboard. I put a lot of work into the upgraded CTP Dashboard, and there's so much coming. I'm coming up with an upgraded CTP Dashboard, poor man's covered call dashboard, where it'll help you do your research finding your next great poor man's covered call candidate. I want you to be a part of it. Check it out. Thank you for the time. Now let's go ahead and look at this. This is the trade setup for Bristol Myers. Now the idea here is that you've downloaded the poor man's covered call tracker. You've now plugged in this trade. Notice a couple things about this trade. Bristol Myers is trading at $66.38. It's a Saturday, so the stock market's not trading. But here's the trade setup, and this is the option I bought. Remember, we have to buy a leap option so we're protected. We're not covered, we're protected. That's very important. I hope you'll watch that video. You understand the difference from being protected and covered. Now, with that said, we picked the January 2022 option. We picked the 10% in the money leap, and we paid $11.40 for that. Now, I'll be honest with you, looking at the numbers, if you understand options pricing, the first thing that's going to jump out at you is this. We paid $11.40 for this leap. Now, with that said, there is $4.77 of time value. Yes, I love buying the 10% in the money leap, but really what we're looking for is that time value to be so small that this option that I'm buying is close to real money. And in fact, if you go to an options chain on Bristol Myers, had we bought the 55 leap, there's less time value even though we spent more money on the option. But look, the consensus on YouTube and all the gurus, they'll tell you we buy that 10% in the money. I've done it, and I'm going to use it here. Now, with that said, that's our setup. Now, this is our very first trade. Now, I'm going to go to the charts here. We're going to talk about this, but the idea is this. We now have that leap. right? We have the protection. We're able to write a covered call, and if our shares are taken away, we can then exercise our leap, taking somebody's shares away from them for 59. We can cover the debit in our account because your brokerage is going to put a debit in your account on Monday morning. See, you don't own the shares, but the brokerage is going to stick you with that debit. That debit being the strike price of the covered call that you sold. In the middle, you see the covered call we're about to sell. Now look, it's February 14th. I place this trade for 30 days. That's what we're always looking to do. It's an out of the money strike. Right? We don't want to write an in the money strike or an at the money strike, and then you're dealing with this because you have to do stuff, right? If your shares are taken away, we have to manage the trade, whether we close out the trade or they're going to exercise and you're going to have to put money into your account. What we're looking to do is write that out of the money. Low delta, right? We want to try to have low delta plays. Remember what delta predicts, right? The probability that the trade will get to your strike price. I hear a lot of people comment that they love using those 25 delta plays because the chances of it getting to your strike price in the 30-day period, only 25%. And for most people, the trade will expire worthless. You keep the premium, you do it again. Now, with that said, let's talk about this trade again. I have set it up such, and the stock trading at 66.38, we have written the 68 30-day covered call, and they're going to pay us 88 cents. So that's $88 back to us in covered call income. Now let's talk about that option. We literally just bought this option. So this option has 2 full years to expiration. Chances are this option's not going to move much. But do understand, there's time value in that option. So every single day that goes by, time decay is happening. Now, what you need to do is go to Google and search time decay options chart. You will see the graph that shows that time decay generally does not accelerate to the final month or week of the option. In this case, we got 2 years. I wouldn't focus so much on this option if the stock has not tanked. And in this case, it hasn't. I mean, we literally just put on this trade. So let's talk about early expiration. Let's fast forward. It's now March 13th, and Bristol Myers has rocketed higher above your strike price. Let's go to the chart and see what that looks like. So in our hypothetical trade, let's say March 13th, Bristol Myers is trading at 70. Well, you placed a covered call for 68. This thing is $2 in the money, guaranteed. They're going to exercise, and you're going to owe them 100 shares. Well, you don't own 100 shares, but you're going to be debited 100 shares, $68. That's $6,800 in your account come Monday. Now, with that said, you would probably exercise your option. I'm not saying to do that, but the point is, that's why we buy that leap, because now you're protected. Again, you're not covered. And chances are, in this case, you might make a little money. The stock has gone higher. Your call option probably went higher, right? Well, let's not focus on that. Let's focus on early expiration because your shares are going to be taken away and how you deal with it. So now let's say it's the week of expiration and it's trading above 70. Now they haven't exercised your option because most options are exercised on the day of expiration, that Friday, March 13th. Unless there's an X date that same week, then they're going to exercise early so they own the shares, collect the dividend, and then probably sell the shares. So here's the deal. Let's say there's no early expiration. Let's say there's no X date and there's really no reason they're going to early exercise. But again, you have to do something, right? You know come Friday, it's going to trade above 7. Well, usually what I like to do is come back a couple days, okay? I come back a couple days, probably 3 days. I got to make a decision. Do I want to continue this poor man's covered call trade? And most of the time you do, right? I've heard covered call writers on YouTube use a single leap option some 25 times. I mean, that's absurd to me. But hey, some traders are better than others, and that's where it's important to understand the strategy, understand how this trade works, so you're prepared. Now, in this case, it's 3 days early. I know the shares are going to be taken away. I have to do something. Clearly, the stock is above my strike price by $2. So you know right off the bat, this option is worth at least $2, right? It has $2 of real value in the option, intrinsic value. Then there's going to be a tiny sliver of time value. We only have 3 days left, so time decay has eroded the time value portion of this option. I'm going to guess that this option is probably worth about $2.10. So you got paid 88 cents. The option is now trading for $2.10. The stock's trading for 70. You know your shares are going to be taken away. What do you want to do? If you want to keep this trade going, you're going to have to buy this option back, adding to your cost basis. Clearly, the option is trading for $2.10. You know your shares are going to be taken away. Let's do the math. You got paid 88 cents. Here's the thing. Your leap option is probably moved higher, so you've actually made money here. Because you don't own the shares at 68 and the stock's now at 70. You didn't reap that gain. But your leap option has. With this option, you're going to have to buy it back. You know you got paid 88 cents. It's going to cost you $2.10 to buy it back. When we cross out the 88 cents, your true debit is $1.22. Now, that is a true debit. You don't own the share, so there's no stock appreciation here for you. Only the leap option appreciation, for which you could sell the leap option. But remember, you're probably not going to sell that leap option because you want to write the next covered call. So what I do is I go over to my poor man's covered call tracker. I'm going to plug in the negative 22 here, which shows us our cash on cash profit of negative 10%. But notice I plugged in an additional $2 on this call option. So you paid $11.40 for the leap call option, but you could probably sell it right now for a credit. And as you can see with our numbers, your total profit is still positive, even though you took a loss on the covered call buyback. So now what do? You regroup, you write that next 30-day covered call, you repeat the process, and hopefully you're writing those out of the money strikes with the low deltas where the next trade will expire worthless. You keep the entire premium and you can start adding to this row here as this trade plays out. Now I'm going to leave it right there. This video is going to be a part of a larger library of poor man covered call video that try to up your game. We're going to talk about all the little integral things that come with this strategy. Because remember, we have to buy an option. And you know we love selling. Sell on this channel. I love selling premium. With the poor man's covered call, you have to buy options, and sometimes it can get a little dicey. We're going to talk about them here. That's why I want you to subscribe to the channel. It's right there. It's free. If you love this video today, bang that like button. It lets me know you like what I'm doing. Ring the bell so you get that email notification the next time I do a red hot covered call video. I want you to comment below. Let me know the stocks you trade and the deltas you trade for your poor man's covered call. Hey, look, until next time, may all your covered calls be profitable.